What I'm about to tell you, most financial advisors will never say out loud. Not because they don't know it, but because if you knew this, you might not need them anymore. These are the 5 retirement secrets that the wealthy quietly use to protect and multiply their money, while the average person works 40 years, saves diligently, and still ends up broke by 75. And before you scroll past thinking, this doesn't apply to me, stop, because secret number 3 alone could save you over $200,000 in hidden fees you didn't even know you were paying. Stay until the end, because secret 5 is the one they specifically don't want you to share. I'm not here to sell you anything. No product, no course, no affiliate link, just information that took me years to learn, and that I wish someone had told me at 30. Let's begin. Secret number 1, the Roth conversion ladder. Here's a question. When you retire, what tax bracket do you think you'll be in? Most people assume they'll be in a lower bracket in retirement. That's what conventional wisdom says. Spend less, earn less, pay less tax. Simple. That assumption could cost you hundreds of thousands of dollars. Here's why. When you retire and start pulling money from a traditional 401k or IRA, that money is taxed as ordinary income, every single dollar. And here's the part that nobody tells you. Required minimum distributions, or RMDs, kick in at age 73. The IRS mandates that you must start withdrawing from your retirement accounts, whether you need the money or not, and every dollar you pull out gets taxed. Now couple that with Social Security, which can be up to 85% taxable, and suddenly your retirement feels a lot like a second career of paying taxes. The Roth conversion ladder lets you move money from a traditional IRA into a Roth IRA over a series of years, paying taxes now at a lower rate, so you pay 0 taxes later when the balance is much larger. Here's how it works practically. In years when your income is lower, maybe early retirement, maybe a down year, you identify a conversion window where your taxable income is in the 12% or 22% bracket. You convert a chunk of your traditional IRA into a Roth IRA. You pay taxes on that converted amount at your current lower rate. After 5 years, the Roth 5-year rule, that money can be withdrawn completely tax-free, including all growth. Repeat the process over multiple years to systematically empty the taxable accounts. The result? You arrive at age 73 with little to no money left in taxable accounts. No RMDs, no forced income, no unnecessary tax bill. Just a Roth IRA sitting there, growing tax-free for the rest of your life. Many financial advisors earn fees based on assets under management. Moving money around, even strategically, creates paperwork and potentially reduces their commission. Always ask who benefits from the advice you're receiving. Pull up your traditional IRA balance today. Calculate what your income will look like in years 1 through 5 of retirement. That gap between your income and the top of the 22% bracket, that's your conversion window. Secret number 2, the HSA triple tax advantage. Raise your hand if you have a health savings account. Now keep your hand up if you're using it as a long-term investment vehicle for retirement. Almost every hand just went down, and that's the problem. Most people treat an HSA like a spending account for doctor visits, but that is one of the most expensive financial mistakes you can make in your 30s, 40s, or 50s. Here's the truth. The HSA is the only account in the entire US tax code with a triple tax advantage. Tax-deductible contributions. Every dollar you put into your HSA reduces your taxable income, dollar for dollar. Even better than a 401k in some scenarios because it reduces both income tax and self-employment tax for the self-employed. Tax-free growth. Any investments inside your HSA grow completely tax-free. You can invest in index funds, ETFs, mutual funds, and none of the gains are ever taxed as long as the money stays in the account. Tax-free withdrawals. Withdraw the money for any qualified medical expense. Completely tax-free. And here's the hidden gem. After age 65, you can withdraw HSA funds for any reason, and it's taxed just like a traditional IRA. Non-medical withdrawals after 65 aren't penalized. It essentially becomes a second IRA. Pay your current medical bills out of pocket. Save every receipt. Let your HSA grow invested for 20 years. Then at retirement, submit all those old receipts and reimburse yourself tax-free. The IRS has no time limit on HSA reimbursements. In 2024, the HSA contribution limit is $4,150 for individuals, $8,300 for families. If you're 55 or older, you can contribute an extra $1,000. Max this out before you even think about contributing extra to your 401k beyond the employer match. If you'd invested $8,300 per year in an HSA starting at age 35 with a conservative 7% annual return, by age 65, you'd have over $787,000, tax-free. Tell me again why everyone isn't doing this. Secret number 3, the fee parasite. This one makes me angry every time I talk about it, because it's legal, it's standard, it's widely accepted, and it will quietly drain over a quarter of your retirement savings, and most people will never see it happen. I'm talking about investment management fees. Here's the math. Imagine you have $500,000 invested at age 45. You expect it to grow at 7% annually for 20 years. Without any fees, at 65 you'd have approximately $1.93 million. Now add a 1% annual management fee, which is considered low in the industry. Your net return drops to 6%. At 65, you have $1.6 million. That single percentage point cost you $330,000. That's not a rounding error. That's a vacation home. That's your children's inheritance. That's a decade of living expenses. And most people are paying between 1.5% and 2.5% in total fees when you account for advisor fees, fund expense ratios, and hidden trading costs. Layer 1, advisor fee, usually 0.5% to 1.5%. Layer 2, mutual fund expense ratio, 0.5% to 1.2% for actively managed funds. Layer 3, transaction and 12b1 fees, often buried in the prospectus. Added up, and 2% plus is frighteningly common. The fix is brutally simple. Index funds. The Vanguard Total Stock Market Index Fund has an expense ratio of 0.03%. That's 3 cents per $100 invested. The S&P 500 Index Fund at Fidelity, zero. Literally $0 expense ratio. Study after study, including ones from Vanguard's own research, shows that over 15-year periods, more than 90% of actively managed funds underperform their index benchmarks after fees. You are paying more to get less. Action step. Log into every investment account you own. Find the expense ratio for every fund you hold. If any are above 0.2%, you are almost certainly overpaying. Google equivalent index fund for each one and calculate what the difference would be over 20 years. That number will change your financial life. Secret number 4, the Social Security timing trap. Quick question. What age can you start claiming Social Security? 62. That's the answer most people know, and 62 is exactly when most people claim. In fact, roughly 35% of Americans claim Social Security the moment they become eligible, and almost all of them, without realizing it, make one of the most expensive financial decisions of their lives. Here's the structure. Your full retirement age, or FRA, is either 66 or 67 depending on when you were born. If you claim at 62, your benefit is permanently reduced by up to 30%. If you wait until 70, your benefit is permanently increased by 32% above your FRA amount. That's not a temporary difference. It's locked in for the rest of your life. If your FRA benefit is $2,000 per month, claiming at 62 gives you approximately $1,400 per month. Waiting until 70 gives you approximately $2,640 per month. That's a $1,240 per month difference. Over a 20-year retirement, that gap is $297,600 before inflation adjustments. But what if I die early? The most common objection. Fair point. The break-even age for waiting from 62 to 70 is roughly age 80. The average 62-year-old American today is projected to live to 84 for men and 86 for women. Statistically, most people will break even and come out ahead by waiting. The spousal benefit multiplier. If you're married, this decision is even more critical. The higher earner's Social Security benefit becomes the survivor benefit when one spouse dies. If the higher earner delays to 70, the surviving spouse receives that larger benefit for the rest of their life. This single decision can dramatically improve financial security for widowed spouses. The secret strategy. If you need income between 62 and 70, consider drawing down from your IRA or 401k first. Even though it feels counterintuitive, this lets Social Security grow at 8% per year, the delayed credit rate, while you live off invested savings. An 8% guaranteed annual increase is something no market investment can promise you. Action step. Go to ssa.gov and create a My Social Security account. Pull your actual projected benefit estimates at 62, 67, and 70. Run the break-even calculation for your specific numbers. The difference will shock you. Secret number 5, the sequence of returns risk. I saved the most dangerous one for last, because this is the one that's destroyed more retirement plans than all market crashes combined. It's called sequence of returns risk, and most people have never heard of it, including frighteningly many financial advisors. Here's the concept. Two people retire with identical $1 million portfolios, identical 7% average returns over 30 years, and identical $50,000 annual withdrawals. One runs out of money at year 22. The other still has $1.2 million left at year 30. What's the difference? The order in which the returns happen. If markets crash 30% in years 1 and 2 of retirement, right when you're withdrawing money, you're selling assets at the lowest prices to fund your lifestyle. This permanently reduces your share count. When markets recover, you have fewer shares to recover with. The damage is irreversible. This is completely different from market risk during accumulation. When you're young and markets crash, you're actually buying low. When you're retired and markets crash, you're selling low. The math flips completely. The 4% rule. Danger. The famous 4% safe withdrawal rate was calculated assuming a static return environment. It does not fully account for sequence risk in bad market environments. Retiring in 2000 right before the dot-com crash, or in 2007 before the financial crisis, exposed retirees to brutal sequence risk that the 4% rule struggled to absorb. Strategy number 1, the bucket system. Divide your retirement savings into 3 buckets. Bucket 1, 1 to 2 years of living expenses in cash or short-term CDs. Bucket 2, 3 to 10 years of expenses in conservative bonds and dividend stocks. Bucket 3, everything else in growth-oriented index funds. When markets drop, you spend bucket 1, never touching bucket 3. This gives your growth assets time to recover without forced selling. Strategy number 2, flexible withdrawal rate. Instead of withdrawing a fixed dollar amount, withdraw a fixed percentage of your portfolio's current value each year. In bad years, you spend a little less. In good years, a little more. This dynamic approach dramatically reduces the chance of portfolio depletion. Strategy number 3, income floor. Guarantee a floor of income that covers your basic needs, Social Security, an annuity, or pension income, regardless of what markets do. This means you never have to sell assets in a crash. Your discretionary spending can flex. Your essential spending cannot. Strategy number 4, 1 more year of work. Adding even 1 or 2 additional years of work in your early 60s serves a triple function. You accumulate more assets, you delay withdrawals, and you delay Social Security. Research shows this can increase retirement security more than almost any other single decision. The terrifying truth, most people retire the moment they feel ready, without accounting for what a market crash in year 1 or 2 would do to their plan. Build a portfolio that can survive the worst case scenario, not just the average case. Let's recap the 5 retirement secrets that the financial industry hopes you never learn. Secret number 1, the Roth conversion ladder. Strategically move money into a Roth IRA during low-income years to create a tax-free retirement income stream and eliminate RMDs. Secret number 2, the HSA triple tax advantage. Use your HSA as a stealth retirement account, tax-deductible contributions, tax-free growth, tax-free withdrawals, and let compound interest do the work for 30 years. Secret number 3, the fee parasite. A 1% management fee can drain over $300,000 from a $500,000 portfolio over 20 years. Switch to low-cost index funds immediately. Secret number 4, the Social Security timing trap. Claiming at 70 instead of 62 can add $180,000 to $300,000 plus in lifetime benefits. Wait if your health and finances allow. Secret number 5, the sequence of returns. Risk. The first 5 years of retirement are the most financially dangerous of your life. Use the bucket system and income floor to protect yourself. None of this requires you to be wealthy to start. It requires you to be informed. And now, you are. Share this with one person you care about who's within 10 years of retirement. Not because of me, because the person who needs to hear this most is probably someone you know. The time to act on this information is not when you're 72 and watching your portfolio shrink. The time is today. If this changed how you think about retirement, subscribe because the next video is going to cover something even more dangerous. The 3 ways your family could legally inherit nothing from your estate and exactly how to stop it. You didn't stumble onto this video by accident. Your future self sent you here. Listen to them.